Today is February 25th, 2026. Welcome to the Weekly Market View by Cindy Fintech CFA. The AI boom and the bull market it's driving are entering a new phase. It's not just about tech stocks anymore. Things are spreading out in ways we haven't seen before. Investors are starting to realize this AI revolution is different from past tech cycles. It's changing how we think about economic growth and productivity in fundamental ways. Here's what's happening. First, natural resources have become critical to this tech revolution. We're seeing a ripple effect. Commodity prices are being revalued, and massive investments are flowing into construction and power generation. AI data centers need enormous amounts of electricity. After all, this is not a consumer-driven revolution. For the first time in a long time, we're moving away from consumer spending as the main growth driver and towards business investment as the engine of growth. Second, while AI productivity gains sound encouraging, translating them into stock market profits is more complicated than it seems. For years, U.S. stock indexes have been dominated by asset-light tech companies with recurring revenue models. Think software businesses with almost zero marginal costs. They could grow revenue without spending much more money, which meant record profits. But now, these same tech leaders are becoming capital-intensive, cash-hungry businesses. Every time they adopt more AI, their computing costs went up significantly. So here's the key shift. Profit margins are likely to move away from traditional tech companies and toward non-tech sectors, especially infrastructure-related industries, at the expense of consumer-focused companies. This makes diversified, balanced portfolios more important than ever. Here's what we recommend. Focus on U.S. companies that are actually delivering earnings right now. Take profits from small cap, micro caps, and speculative stocks. Redeploy that money into large cap, high-quality companies, including selecting Magnificent Seven stocks that still make sense, but broadening beyond that. Looking at companies benefiting from AI productivity gains in finance, healthcare, industrials, and energy sectors. For passive investors, balance your exposure between regular market cap-weighted index funds and equal-weighted funds. Consider using active fund managers for up to half your portfolio. Don't forget to invest outside the U.S., particularly in emerging markets. And keep key allocations in hedge funds, gold, and infrastructure. The AI revolution is real, but the way it creates value in the stock market is changing. Your portfolio needs to change with it.